Welcome to today's Explainer. We're going to dive headfirst into a frankly terrifying viral post that's been spreading like wildfire across social media lately. The post makes this incredibly bold, super scary claim that investors who bought into the S&P 500 since 2008 have made absolutely zero money. Not small gains, not just average returns, but literally nothing. It sounds shocking, right? Well, today we're going to look right past the hype and uncover the actual math behind this wild claim.
So, did you really make zero money since 2008? This is one of those shocking claims that relies heavily on very serious-sounding terms. Things like currency debasement, the idea that your money is just becoming worthless, along with warnings of rampant inflation and a catastrophic 1929-style crash. It's designed to spread panic. And honestly, at first glance, the charts and the rhetoric they use look incredibly convincing. But as we're about to see, a compelling story isn't always a mathematically accurate one.
Here's our roadmap for today's Explainer as we systematically peel back the layers of this claim. We'll kick things off with Section 1, the zero returns myth. Then 2, the real market math. Next is 3, the missing piece, dividends. We'll follow that up with 4, M2 versus reality, and finally wrap it all up with Section 5, building wealth over fear. All right, Section 1, the zero returns myth, and exactly why it feels like some sort of hidden insider truth. This post is actually kind of brilliant in how it's designed. It perfectly combines scary financial jargon with these doomsday predictions that prey directly on our natural economic anxieties. When a slick-looking chart screams at you about a crash worse than the Great Depression, it just paralyzes you, right? It feels like this forbidden knowledge that Wall Street has been hiding from us. And that is exactly why it's spreading so fast. But feeling true and actually being true are two very different things. So let's separate the emotion from the actual data.
Moving on to Section 2, the real market math. Let's look at the actual numbers here.
Let's rewind the clock for a second and start with the raw facts. Right before the absolute worst financial crisis in modern history, back in 2007, the S&P 500, which tracks the top 500 U.S. companies, was sitting right around 1,565 points. Keep that baseline in your head. Now, fast forward to today, and that index is sitting in the thousands. We are talking about growth of hundreds of percent, meaning even if you were quite literally the unluckiest investor in the world, even if you dumped all your money in at the absolute worst possible time, right before the 2008 crash, your initial investment would still be up significantly today. Now, I know what you're thinking, and it's exactly what the creators of this viral post always counter with. Yeah, but what about inflation? And look, inflation absolutely matters. Over the long haul, it for sure eats into your purchasing power. But even when we adjust for inflation, this whole idea that the market yielded absolutely nothing, it completely falls apart. The S&P 500 has consistently delivered strong, real returns over time. The math just frankly does not support this zero returns narrative. Which brings us to Section 3, the missing piece, dividends. This is honestly the biggest trick of the entire viral post. Here's the kicker. The viral post assumes you only buy the index price, and that's it, nothing else. But come on, real investors don't do that, right? People invest through standard index funds, like the incredibly popular ETFs SPY or VOO, which automatically pay out and reinvest your dividends. Over time, those reinvested dividends make up a massive portion of your total market returns. When you look at the total return, historically, reinvested dividends bring your long-term average annual returns up to around 10 to 12%. That is a super strong positive return, even after you factor in inflation. By conveniently ignoring dividends, this viral post is ignoring literally one of the most fundamental wealth-building mechanics in all of investing. All right, let's hit Section 4, M2 versus reality, where we're going to debunk this whole money supply argument. The myth leans really heavily on comparing the stock market directly to the M2 money supply. For anyone who might not be super familiar, M2 is essentially just the total amount of all dollars currently in circulation. And yeah, it is entirely true that the M2 money supply has exploded and increased significantly since 2008. But here's the massive flaw in using that to claim your investments are worthless. It's a textbook false equivalence. On one side, you have the M2 money supply, which is, great for monetary theory charts and deep macroeconomic debates. But on the other side, you have actual reality. You have consumer price index, or CPI, inflation. That's the actual cost of your rent, your gas, your groceries. You don't buy groceries with M2, right? You don't pay your rent with M2. We live in the daily reality of CPI inflation, not inside a theoretical macro chart. It's a super fascinating economic discussion for sure, but translating an expanding M2 supply into the phrase "you made zero money" is just fundamentally wrong.
Now, look, to be totally fair, debunking this myth doesn't mean the market is just some magical, risk-free money printer. Valuations right now are relatively high, and it's entirely possible our future returns might be lower than the insane run we've seen over the past decade. It's also completely true that market corrections of 20 to 30% happen regularly. They're just a normal part of the cycle. But screaming that the next crash is going to be just like the Great Depression, that's fear-based storytelling, not actual analysis. We have modern structural protections baked into our markets today that literally just didn't exist in 1929. So yeah, crashes will happen, but a total economic collapse scenario is far, far less likely today.
Finally, Section 5, Building Wealth Over Fear. Let's talk about the real lesson for investors here. So how should you actually navigate these viral claims when they inevitably pop up on your feed again? Well, the true lesson here is to focus on your process and completely avoid emotional reactions. Just don't panic sell because of a scary post on social media. Match your investments to your personal time horizon and just accept that, hey, volatility is totally normal. And maybe most importantly, do not try to time the market. Timing the market is incredibly dangerous because missing just a few of the very best market days can permanently wreck your long-term returns. Staying consistently invested is the real key. And the really great news? Tapping into this decades-long compounding machine is literally easier than it has ever been. The barriers to entry are practically zero now. Today, modern platforms let everyday people start investing globally in minutes. You can start building a portfolio with major US stocks for literally as little as $1. It takes less than 10 minutes to set yourself up for building long-term wealth. I want to wrap up with a quote directly from our source material that just absolutely nails everything we've talked about in this explainer today. Fear gets clicks, but compounding builds wealth. The S&P 500 did not deliver zero returns since 2008. It delivered decades of compounding growth, powering straight through crashes, crises, and pandemics. So I'll leave you with this one final thought. The next time you're doom scrolling and some terrifying world-is-ending post crosses your feed, just stop for a second and ask yourself, are you letting social media algorithms dictate your financial future? Are you making your big investing decisions based on solid math or just a really compelling fear-based story? Thanks so much for joining me for this explainer. Remember to focus on the math, stick to your process, and let compounding do all the hard work for you. See you next time.